Biztech's Property Show. Today, we look at the Australian commercial property market. Now, to give us insights, we have Benjamin Martin Henry. He's the head of real assets research for the Pacific at MSCI, and he's based out of Sydney, Australia. Now, Ben has over 15 years of experience in Australia and the UK, and he leads in developing thought leadership content that benefits MSCI's clients and covers major property and emerging sectors. Now, to tell us more, Ben, welcome to the show.
Thank you so much, Brian. It's great to be here.
Now, Ben, could you give us, for a start, an overview of MSCI and its history?
All right, so I'll talk more on the property side because that's the part I cover, but we have various indices covering equities and bonds and all types of things. But on the property side, well, what we actually do is we compile property data and we create indices based off of that. And a couple of years ago, we bought a company called Real Capital Analytics, which is where I came from, which covers the commercial property transactions part of the market as well. So very much these two data sets go hand in hand, looking at transactions and performance.
Now, could you start by then giving us a brief overview of the Australian commercial real estate market year to date in 2023 compared to previous years?
Most definitely in a period of flux. The last few years have been, as we all know, particularly turbulence for obvious reasons, and the property market has been turbulent as well. And what I've been saying over the last few years is, as a researcher, it's been an absolute nightmare because researchers, we love to talk about percentage changes in anything. And in transaction volumes, well, in 2020, everything was down 500%. In 2021, everything was up 500%. In 2022, everything was down 200%. That's the kind of fluctuations that we've seen over the last couple of years. Now, in 2023, what we've seen is significant declines in transaction volumes. The world is going into this period of high interest rates and uncertainty, and that is leading to a slowdown in property transactions.
Now, Ben, give us a sense of what the various sectors look like, because, and I want to break down the panic perhaps that are in other markets. So in the US, basically vacancy rates on commercial offices are around 19%. Europe, it's around 7%. There's a real fear creeping in the commercial real estate space in those areas. What does it look like in Australia, particularly obviously in the key sectors around office, industrial, retail, and hotels?
I think we're starting to see the kind of pain that we're seeing in global markets as well in the office sector, or as I call it, the much maligned office sector. It's certainly taking a bit of a battering. We haven't seen the value declines in Australia that we have seen overseas. I would expect June valuations to actually show a bit more of a decline, somewhere in the region of that sort of 5 to 10%, but still not even close to what we're seeing overseas. Now, on the flip side, the retail sector, whilst it is still declining, it's actually not as bad as people might think, but that's mostly because of the fact that when COVID hit in 2020, all non-essential retail services were closed in Australia. And what that meant is that there was a big hit to values of retail assets, and they have not clawed those losses back yet. So whilst retail is still declining, it's not nearly as bad as the office sector because values already adjusted. Now, industrial, everyone loves industrial. It's still going extremely well. It's been the love child of property for the last few years. It's been doing fantastically well, but it too is slowing down as well, and that comes as no surprise. What goes up generally will come down.
Now, Ben, I want to drill down in terms of given this uncertainty in the scenario, obviously there is a pullback in terms of buyers or interested buyers, but there, I'm sure in certain sectors also, bottom fishers starting to look around as well. Where are you seeing activity, and where is there nibbling, and who are the buyers out there?
So we are seeing a bit of activity in the retail space, actually, in particular, from opportunistic plays. Industrial's still going pretty well. There's still a lot of activity, still a lot of buyers. They're being a bit more circumspect because pricing obviously got quite elevated. So they are picking and choosing. But retail seems to be the most interesting sector at the moment. Because of those value adjustments I mentioned before in 2020, there are a lot of opportunities to pick up retail assets at pretty good discounts to 2019 valuations. And we're mostly seeing private investors get into the retail space. Private investors tend to be a bit more opportunistic, And therefore, those are the ones that are really shopping around for good deals at the moment. Institutional investors, by and large, they're pretty quiet at the moment, but it really is those private buyers we're seeing the most activity from.
Okay, when you're talking about private buyers, what sort of yields, as you said, they're more opportunistic. Probably they are sniffing around right now, as you outlined. What sort of yields would they be comfortable with when compared to, say, more institutional buyers?
I think it does depend on the asset type. I always say that about retail. We have such a big mix of retail in Australia. It's not just big shopping centres. It's neighbourhood shopping centres which have been performing extremely well. They're trading in and around that 4 to 4.5%. And then you get things like large format retail, which is fridges, sofas, desks. Obviously, when COVID hit, we're all forced to work from home here, so we had to buy office desks and chairs and screens. So those large format retail assets really performed extremely well. They're also sitting around that sort of 4.5 to 5% mark. But in terms of some of the more opportunistic players, particularly the larger shopping centres, we are seeing yields in kind of that 6, 7, 8% range, which is pretty high. And generally the institutions, they look for a little bit tighter yields than that.
And so this is the conundrum, isn't it? Because if you want to look at assets like this right now, and your risk-free rate is above 4%, the numbers don't really stack up unless you're in the 6, 7, or 8% range.
That's exactly right. And that is why we are seeing such a pullback. Also, that's a big reason why we're seeing such a pullback in the investment market. The valuations simply have not adjusted as quickly as other markets, and that risk premium, it's no longer there for Australia because bond yields have obviously moved up. So deal making is becoming harder, and it is becoming very, very deal specific as well. Okay,
so if this is the case, there's still a standoff then. So the buyers are not willing to lower their prices. The sellers obviously are not biting because the yields don't justify any sort of take up. Do you see the standoff? Do you see that this standoff will basically result in the sellers starting to cave in terms of their asking prices?
We actually do model that gap between buyer and seller expectations, and it is quite interesting at the moment. So we've got retail sitting at around a 20%, buyers want a 20% discount, and industrial and office around that sort of 15 to 17% discount. So this is to bring transaction levels back to long-term averages. Now that gap, it has to converge in order for the market to start moving again. Now the only time that's going to happen is when sellers feel that they have to sell. If they have to raise capital in order to pay down debt or what have you. But at the moment, we're just not seeing a lot of distress selling in the market. Now, similar in the US, there's just not a lot of distress selling at the moment. I know there's lots of newspaper headlines saying there is, but there's really not. We are able to track this quite well. It is starting to turn over there, and generally Australia will follow. But as yet, most funds are still pretty well capitalized because debt obviously has been quite cheap for quite some time. So they are reasonably well capitalized. So until there is this need to sell assets, until there is this distress selling, can't see that gap really converging. Sellers are happy to sit and just wait it out and hopefully do better on the upswing.
Ben, the only push factor will be then if vacancy rates start to go up. What are they looking like in Australia in the various sectors?
So industrial, extremely low, which is why we're seeing such extraordinary rent growth on the industrial sector. We're not seeing much cap rate compression anymore in the industrial space, but that rent growth really is going pretty well. Office is that's where the pain is. Sydney, Melbourne, well above long-term averages. Sort of double-digit vacancy, where long-term vacancy is around sort of that 7-8%. So a few years ago, Sydney was down to 4%. So the fact that we're in double digits, sort of 12-13%, it's a pretty bad sign for the market. Melbourne similar. Brisbane a little bit better. Brisbane and Perth are more counter-cyclical markets. So their vacancy, whilst is higher than Sydney and Melbourne, for them, their long-term averages, they're actually sitting pretty good. But it really is Sydney and Melbourne that are seeing the most problems, particularly Melbourne, because over the last couple of years, there has been a lot of stock coming into the market, which obviously needs to be filled.
Okay, now speaking for a lot of stock, there has been a lot of Southeast Asian investment, both in huge high-rise residential as well as commercial real estate in those two markets, Sydney and Melbourne. Could you give us a sense of where they've traditionally invested in and developed, and how that's impacted the market and how you see it moving forward?
Simple answer, office. 49% of overseas capital in the last 5 years has gone straight into the office sector. For every single year that we've tracked commercial property transactions from overseas investors into Australia, office has been the #1 sector. Even with this great boom that industrial has been on, still overseas investors prefer offices in Australia. And that might be a big reason why investment has been so low so far this year for overseas investors, because they traditionally go into the office market. But as we know, the office market has a few problems at the moment. But interesting on the residential side, build to rent is obviously a very new sector in Australia, but it is starting to grow. There is a significant pipeline of construction, and most of it has been funded by overseas parties, particularly from Asia. And by build to rent, I mean multifamily. Build to rent is what we call it in Australia, but it's called multifamily in most other countries in the world.
And looking ahead in 2023, 2024, what are some key trends that you're seeing in terms of investment? Because obviously, from what you've had alluded to, industrials is relatively undersupplied.
I think industrial will continue to grow. We'll continue to see strong rental growth, and we'll continue to see strong investment into that sector. Pricing may need to adjust a bit though, given where the risk-free rate is. We are seeing a lot of investment in so-called alternative spaces as well. You know, build to rent I mentioned, but also healthcare. I know PNB picked up a big share of a healthcare fund last year. Also in childcare, data centers. A lot of the investment at the moment is looking at those more alternative sectors, moving away from the core office, retail, industrial, and going into those more niche sectors where returns are a little bit higher. And there's a bit more stability in it, particularly in that healthcare space, because I don't think I've ever seen a headline anywhere in the world where it says, we have too many hospitals. I just don't see that happening.
Yeah.
So this is the place where investors are getting into.
Ben, it's been a very insightful conversation. And obviously, you've given us a very good insight into the commercial real estate space in Australia. But before we leave, any final thoughts you'd like to leave us with?
I think it's just watch this space. As I said, the last few years have been extremely turbulent. It's been very interesting. But in this type of situation, there's a lot of opportunities out there. So I do expect to see a lot of movement. And in Australia, we do love to fish. And there's always this fishing analogy, which is you don't fish, no run, no fun. You don't fish on a non-moving tide. And a lot of opportunistic investors don't invest unless there is this turbulence in the market. And we're seeing a lot of that now. So I do expect activity to pick up, and it's going to be an interesting watch.
Ben, thank you very much for taking your time to be on the show.
Absolute pleasure. Thank you for having me.
We've been speaking to Benjamin Martin Henry. He's the head of real estate research for Pacific at MSCI. I'm Brian Fernandez, and you've been watching and listening to Biztech's Property Show. This interview will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.